Good afternoon, everyone. Welcome to the LSE Alternative Investment Society Fireside Chat with Mr. Ray Dalio. I'm Shota Shiukashvili, outgoing co-chair of the LSE Alternative Investment Society, and it's my privilege to moderate this discussion with Ray. Ray, we have around 100 students in the auditorium at LSE right now, and another few hundred joining online from across Europe. And it's a real pleasure to have you back at LSE. Since you spoke with us in 2024, a lot has changed in the world, technologically, geopolitically, economically, and hence we're enormously grateful that you've agreed to this follow-up session and that you agreed to share your perspective again with students who are going to be heading into this world soon, starting our careers. And I'd love to give you the floor and start before we dive into the five horses of where the world's going. It would be great if we could hear your story. You always underline that you're not an academic, but a practical investor who over 50 years built Bridgewater from a two-bedroom apartment to the world's largest hedge fund. And your frameworks aren't academic theory, but the product of decades of putting capital at risk and learning from being right and wrong in real time. So before you went on this journey, could you start by telling us a bit about the kid you were growing up on Long Island and the moment you first fell in love with the markets?
Well, yeah, gladly. And by the way, that's why I'm here today, right? I'm at a stage in my life where it's a joy to be able to pass along to you all, who I relate to very well, and in terms of your transition. I just gave a commencement address at the college that I went to, and it was 55 years of learning since I graduated from sitting in their seats. And life is a journey, and until you get out there, you don't know a lot about what it's like. And so it's a joy at my stage in life to be able to pass along whatever I can that's of help to you. Okay, so when I was 12, I caddied. I did odd jobs, but I caddied, and I walked around with when the stock market was extremely hot. This is in the late 60s, and everybody was talking about the stock market. So I took my caddying money. I earned $6 a bag. I carried two bags. I went at $12. When that mounted up to $50, I would put it in the stock market. And the first stock I bought was the only company I ever heard of that was selling for less than $5 a share. And my idea at the time is by doing that, I would buy more shares. And so if it went up, I would make more money. Now, that was, of course, a dumb strategy. And the company was about to go bankrupt. But another company came along. It tripled. I tripled my money and thought I was smart, thought this game was easy, and I got hooked on the game. So I got hooked on the game. It's like a video game. I mean, there's a game of investing, which is a blast as well as very profitable if you do it well. And so I've had these experiences along life. I'll tell you just a couple of more. So when I graduated from college, 1971, I worked on the floor of the New York Stock Exchange as a clerk, and I followed the markets. And on August 15th, 1971, President Nixon got on the television and told the world that the United States was defaulting on its obligation to let them turn their paper money in for gold. I mean, he didn't phrase it that way, but that's what he was doing. And I thought, wow, that's a big crisis. And I went down on the floor of the stock exchange, and I thought the stock market was going to be down a lot, and the stock market was up a lot because I never went through a currency devaluation before. So I studied history, and I found out that in March 1933, President Roosevelt did the exact same thing on the radio, announced the same thing, and the stock market went up a lot because what it was is the devaluation of money and the increased supply of money had that effect. And I realized that if at that point, I realized that many important things happened before my lifetime, that I couldn't rely on just the things that I experienced as in my perspective. And so I studied the 1930s. I figured in history, I need to understand, all big things that happened. And so I studied the Great Depression. And then because of that, was able to anticipate the 2008 financial crisis, the 2010 to 15 debt crisis in Europe, and so on. And so, I mean, I think that's what life is like, right? So you're going to, you studied. I think you probably maybe think you know more than you do, and the markets is a great way to test what you really know. And what you will learn is from your experiences and reflecting well on them. I found that also my most painful experiences were my best teachers. Nobody likes painful experiences, but when you have painful experiences of being wrong, if you reflect well, it'll teach you something about how the world works, how reality works, and how to deal with it. So I started to, when I did that, I would then write down my principles. In other words, principles are sort of if-then statements. If this happens, do that. And I would write those down. And then I converted those into algorithms. The reason I built Bridgewater, the way I built Bridgewater into the largest hedge fund in the world, and made more money than any other hedge fund in existence, and so on. The way we did that was through a combination of these learning experiences and then writing them down and putting them in computer code. AI is a concept that began in 1958. And I was always using computers to make decisions. The Bridgewater, I did, and then but they were expert systems, computer code, because the computer could process a lot more information better, and it would. So as a partner, it was a great thought partner, and now with AI, it's fantastic. So I hope we'll be able to talk about that. But anyway, that's the background.
Yes, yeah, we'll talk about AI as well as part of one of the five forces. And I was wondering, like you mentioned this pain, like you mentioned your painful experiences, and like then you also developed this principle, pain plus reflection equals progress. And you've previously spoken about one of the most painful market experiences of your life, the one that came about with the 1982 Mexico default. And how you had to then borrow money from your father to support the family. And can you walk us through that experience and what it taught you and how you developed the principle?
Yeah, it was such a terrible and great experience, such an example of learning, from mistakes. Yeah. Um, so um, in 1979 and 80, I calculated that American banks had lent to foreign countries, emerging countries, a lot more money than those countries were going to be able to pay back. Um, at those interest rates and that there was going to be the biggest debt crisis since the Great Depression. The numbers were very big, and and that's so I got a lot of attention for that because it was a controversial view. Mexico defaulted in August 1982, and a number of countries defaulted after that. So I was asked to testify to Congress about this. I was asked to appear on the show of the time, which was Wall Street Week. And I thought the stock market would go down, and I couldn't have been more wrong. The stock market went up, and I lost money for me, and I lost money for my clients. And I basically I lost so much money I had to borrow $4,000 from my dad to pay for family bills. So it was a humiliating, painful experience, and I had to wrestle with the question: am I going to go back and get a job on Wall Street? Have to put on the tie and go in the the rail computer railroad and go down that. But what I learned two things. First of all, I learned humility to balance with my audacity, which meant basically, to ask myself, how do I know I'm right? To consider the possibility of being wrong, of making like one big bet and that can have this effect. That seemed pretty stupid. And that then made me so eager to have disagreement with others, to have thoughtful disagreement. The smartest people I can, I want them to stress test my thinking. And then I also learned what I consider the holy grail of investing. If you can do this, you will be very successful in investing, and that is to have 15 good uncorrelated return streams. It's the math of diversification, because when you don't lower your returns through diversification. You still get the average return of all of the things that you're investing in, but you do lower the risk. And if you can get out there and get like 10 or 15, you'll lower the risk by up to 80%. That improves the return to risk ratio by a factor of 5. And when I discovered that, because of that terrible experience, I from then on, Bridgewater was straight up. It was, we from that, and we always did excellent. So Bridgewater's a 50-year-old company, but it was that experience. So I want to emphasize to you that you've got to get out there and you have to have experiences. Experience, is a teacher. And the question is, how good of a learner are you? And if you can reflect on, okay, what does that tell me about how reality works and how I should deal with reality, you will make your progress. The idea of learning by listening to others to tell you what you should do and how you should do it is really, it's an academic exercise that exists only in your early part of your life, because you get in the habit of doing that. And also, what you're doing can make you arrogant, or even averse to being wrong. Like it's an ego thing. How well did you do on your test? And I'm smart, and all of that can make you not be good at experimenting, learning, and so on. So you will, reality will teach you if you're willing to learn through those painful experiences. But I found out that the painful experiences actually ended up, my reaction to the pain changed over time. Like, okay, being wrong, losing money, or whatever painful experience I've had in life, I react differently to it. It's like I view it as a puzzle. Then, if I can solve the puzzle, which is what does that tell me about how reality works and how I should deal with it better, and I get a principle that I can write down and remember and make me better in the future, then it's a really good experience. So my reactions are like that. Another thing I want to emphasize that has helped me a lot is when I was, I think it was 19 years old, I learned to meditate, transcendental meditation. What that gives is a calmness, an equanimity, that when things are coming at you, that you have the calmness and the equanimity to reflect and process it. Not only does it reduce the pain, it gives you a sense of clarity. So that also has helped me a lot.
Cool. And I guess like quite a lot of us on this call, myself included, will be going into market soon, and we'll have our fair share of painful experiences, and hopefully keep your principles in mind. And now going back to the story of like in 1971 when Nixon dropped the gold standard, how that surprised the market's reaction surprised you, and you dived into the history, and you say you learned 500 years of human history and analyzed the situations, which then led you to develop your framework of cycles concentrates around the five big forces. So before we dive into the main part of this session and discuss those five forces in the current world, can you briefly walk us through that framework?
Sure. There are lots of things that are happening now that didn't happen in our lifetime. And because I learned that lesson, and a lot of what's happening reminds me quite a bit of the 1930s. I decided that I wanted to study the rises and declines of reserve currencies and empire, and then it showed up with empires and countries and so on. So I studied that over the last 500 years because, reserve currencies can last quite a while. And I did a study for myself for managing through this. And then I published it as a book called Principles for Dealing with the Changing World Order. So, and I'm very data based. In other words, there are stories, but also I'm into measurement. And so you can see in the book a number of charts that paint a picture and so on. So, to give you the nut in a nutshell, what was very apparent is that there are five big forces. I think you basically can cover almost everything. They fall under these five forces and they evolve over time. The first is, let's say, the monetary order. Okay, the monetary order is the way, order means system, the way the monetary system works, and that means how money and credit create buying, and they create equities, and in their equity markets. It's the whole market economy thing that you've been studying for a long time, how that machine works. By the way, if you're interested in I think it's a 20-minute video I've put together called "How the Economic Machine Works" in 30 minutes. 20 how the economic machine works in 30 minutes. It's on YouTube. People like it. It's 140 million downloads. Anyway, there's that machine, and that how that force, and that force, just the way that works is there is a debt cycle. There is a long-term debt cycle that works for countries and individuals and companies pretty much in the same way. And the way that is as debt and debt service payments. Well, let me put it this way. Think of the credit system or the capital market system as being a circulatory system that brings capital to different parts of the economy. And if those parts of the economy produce enough earnings so that it pays back and then you prosper, that's a very healthy system. However, when debt and debt service payments rise relative to incomes, it squeezes out spending. So it's like plaque in the circulatory system. It squeezes out the spending. And if that goes on, then it produces the equivalent of an economic heart attack. And the reason that there's a long cycle in it is when you start with not that problem, you can build it up over a period of time. And you can measure it and you can see it in statistics, and it looks like probably watching an MRI of the heart or something. And then the other part of that is that there's a supply and demand for credit. So, when a government, and we'll talk about I'm now talking about government debt, but it's the same for individuals. If you run a deficit, that means you have to borrow money. You've got to get the money. And when you have a lot of money out there and a lot of debt, one man's debts are another man's assets. So there are debt assets and there are debt liabilities. And so somebody's holding the debt assets. which are the bonds or whatever, and they're holding it. And when they have a lot of it already, like there's a lot of dollar denominated debt in the world, and you have a lot of that debt, and then you're having to sell a lot of that debt because you have to finance the budget deficits. There can be a supply and demand issue, and that particularly also that's a greater risk during times of turbulent times. So now I covered force number one. Force number two is political and and social differences. When they're, in other words, basically the left and the right, the rich and the poor, the and values differences, and in cycles when there are very large wealth and values differences, and people believe that the system is not working for them, then that order is in jeopardy. That political order is in jeopardy, and so you have great conflict when it gets so much conflict that you don't even trust the elections or the systems. The system, you could have a type of civil war. The systems sort of break down. And we are seeing that now in its way, in a way that never happened in our lifetimes before. And that has big implications. The first factor, the money and debt and credit thing, certainly has a big effect on the political thing, and the political thing has a big effect on the other because it affects taxes, how people move from one country to another for money, and all of those kinds of things. And so we are seeing sort of a stretching and almost a fraying of that system. And this is not new. Plato wrote about the system of democracy in the Republic, I don't know, it was like 450 BC, and he described the problems of democracy sometimes when it doesn't work for most of the people, and you have these fights, and so everybody can see that. The third force is geopolitical. In other words, how do countries and the second, it's how do people within countries deal with each other. And the third is geopolitical and how do countries deal with each other. And the orders, the systems. And again, most of these orders, all three of these orders, really began, the newer versions began in 1944 and 45. As you would know, the Bretton Woods monetary system was the first. And then many countries they created their new political systems, and then there was the international world order, which was largely influenced by an American but also British to some extent sense of representative democracy in a sense. So the United Nations, and the idea that there would be a world court, a World Trade Organization, a World Health Organization, and that little countries would have a vote like big countries, and that they would work out that system, was basically, somewhat of a naive system, because in order to have this, you still have to have enforcement capabilities. You can't. And so what happens if the enforcers do not like the verdicts? Are they going to turn it over to the World Court and they'll decide and then they'll enforce it? Anyway, that system has broken down. In other words, we have stopped the multilateral rules-based system and replaced it with a power-based system, which is very similar to the systems pretty much that existed before 1945. So, okay, that's change. We're just not used to it, but these things have existed in history. Number three is throughout all time, inventions of new technologies. And of course, this is a very important inventions, AI and so on. But we're always enamored with the newest technology. I'm not saying this isn't a unique, fantastic new technology, but like if you go back to like the 20s, imagine the late 20s when the bubble began and we had that. Imagine that was the first time you had electricity and houses. So first time you have lighting and you have refrigeration, and the first time you have cars, first time you have airplanes, first time you have movies, first time you have all of those amazing new technologies that also ended up creating a bubble that contributed to the bust. So we have, yes, this is amazing new technology. And, you know, we're almost eliminating or certainly greatly reducing what the human's advantage is over machines. You know, in history, through most of mankind, really through the agricultural revolution until we started, you know, sort of in the mid 1600s, we started to change as a result of really the printing press and so on. Then we began an industrial revolution because man's thinking began to play. And before that, man was like oxen. You know, they just worked and there was muscles. And then you get higher and higher and higher levels of intelligence. But okay, so now we're in this AI world. Okay, and then, okay, what is that going to mean? But anyway, the new technologies have always been wealth producers, so they create uneven distributions of wealth naturally. They create, and they are used to make wonderful advances, and they're also used for wars, for conflict in various ways. So while this is a new technology, then there's a lot to be learned about how new technologies, and they're all related. You know, like I was saying, when you look at the, let's say the bubbles, the bubbles come around. You know, and the bubbles have effects when they burst. The bubbles come around when there's a new technology because and there's an inclination of the new technology. Everybody sees it's going to be great and the world's going to change and you want to bet on it. But they don't necessarily view what price they're paying for it. And then sometimes they borrow money to bet on it. And there's a big difference between money and wealth. You know, you can't spend wealth. So when your wealth goes up, and you might have to sell some wealth in order to get money. And so bubbles occur when that happens, usually because you have to pay debt service or you have to pay taxes. So anyway, that's the fourth influence, I would say, technology. Each time is unique, of course, but the patterns aren't unique. And then number five is acts of nature. Throughout history, droughts, floods, and pandemics have killed more people than wars and toppled more orders than the other factors I've mentioned.
Perfect. Thank you very much for the detailed breakdown. I'm now diving into like this forces specifically. So first of all, the debt and the money force. And thanks for walking us through the debt cycles. And based on that, like previously you've used the analogy of plaque accumulating in the heart because of too much cholesterol to describe how that builds up. So currently, where is the United States in this analogy? Like, are there like what are the warning signs, or is it like too late? Is it already in the cardiologist's office, if we can frame it in this way?
It's if I play the role of the cardiologist, and I sort of view myself kind of like a doctor who measures things. I'm not ideological. I'm just measuring things. It is like sitting down with somebody who has an enormous amount of plaque built up, and is and when I look at the projections, um, um, it's going to increase at a fast pace. To put the U.S. Position, but this is not just a U.S. problem. Um, Many countries have this problem. The U.S. position is um, uh, it takes in about $5 trillion a year. It spends $7 trillion a year, so it's spending 40% more than it takes in. It has a debt which is 6 times the amount of money that it takes in. And it is spending $1 trillion a year, so half the budget deficit, on interest payments. And it has to roll over $9 trillion a year of debt in a world. Okay, so the world, and that's now, and it's going to compound. So, in my opinion, there's not a doubt that we're headed for that. I mean, maybe somebody might say, maybe AI will raise productivity and incomes, and so I suppose that's uh, that's not an impossibility. I should acknowledge that. Um, but it is a very risky situation. So it's like sitting down with the patient and saying, you're in this condition, and you're, and we know how it's going to worsen. And often I hear it's like the patient who says, but wait a second, I've heard this notion that if I behave this way, I'm going to have a heart attack, and hasn't happened, and therefore I don't think it's going to happen, and I'm going to go on my ways. Well, it's just a matter of, it's simple numbers and mechanics, where's the money going to come from? So, and it happens with the other stuff going on, like the politics. So, there are big wealth gaps. I go to Washington, and I speak to, by the way, many finance ministers, um, including your own. And when we look at this, it's a basic situation, the politics. There are things that could be done to stabilize it that would have to be, basically, if you'd have to, let's say, raise taxes by 4 or 5%, you'd have, and cut spending by 4 or 5%, and that would naturally bring down uh, interest rates, which would also help to reduce the debt. You can bring it down, to maybe to 3% of GDP or something like that, to try to stabilize it. I don't know if that's good enough, but anyway, that would be that. But the political answer is the one I always get, which is, um, politics is such that I have to make 2 pledges, otherwise they'll throw me out of office. And basically the pledge is, I will not raise your taxes, and I will not cut your benefits.
Okay.
So politics. I'm afraid of what the next downturn is going to look like. I mean, downturns always happen, and you have the next downturn, and then that produces economic pain for everybody. And when they have economic pain, it's not like they're lovely with each other. It can cause worse situations.
Okay, and building up on that, like that brings us to the second force, the internal political force. And you've written about this classic toxic mix of like the big debt you've just described, the large wealth gaps we see in the Western world, and the negative economic shock. The first two are already present in the United States and Europe and so on. But what counts as the negative economic shock? Is it like something sudden, or is it something that's been already accumulating and we should expect soon?
Well, I think that the debt issue, uh, yeah, let me say 2 things. I think the debt issue, as we extrapolate it, is not an exogenous shock. It is, like a disease that we are in, it's like stage 4 of this disease. And we can see that, that can happen. And we can see that the wealth gaps are so large that you can, and the fighting is so great that you can see disruptive things happening from even that. Like, um, if you studied this, by the way, this has all happened in history. And so it's educational to see this pattern over and over again. So what happened when we're at this stage of the disease? And what you see is classically in that environment, you see um, capital controls, um, you know, can't move money out of one place to another. You see big increases in taxation. You see financial repression. In other words, basically keep the money within the country or that location. Don't have it go out. Outlaw inflation hedge assets like gold. I mean, they outlawed gold. Um, why did they outlaw gold? Because they didn't want the money to be stored there. And then they have what we call financial repression, which means push the interest rates down so they're low in relationship to the inflation rate. The inflation rate allows a higher rate of taxation, so you bring in more tax revenue and you inflate the debt away at the same time as it produces, negative real returns, and with a high tax rate, and that's how it's dealt with. So I think um, it's an unhealthy situation. It's not that it needs an exogenous factor. Now, you in a world that has geopolitical risks, the exogenous conflict has exists more. So more likely. Uh, we're now in this new world order. How does this new world order work? It means that since there's greater risk of conflict, then everyone wants self-sufficiency. Countries want self-sufficiency and use economic warfare much more than before. You don't want to be cut off. So you want to then domestically produce. So it's anti-globalization. And when it's anti-globalization, it's anti-efficiency. So you're happy to accept a lower level of efficiency for self-sufficiency. And then you use it as economic warfare, which we're seeing. So the geopolitical conflicts have also bearings on what we might call shocks, just like we're seeing, shocks now. Um, uh, 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 well, you know the shocks, so I don't have to go down the list of them.
Sure. And before we move on to the geopolitical side of things, so I guess like one of the symptom, as you've described, of the current political systems is the rise of populism. And you've described it as a symptom, not as a cause, that you've described that populism emerges when a system stops delivering. And I guess then it plays into making the situation worse for like responsible economic policies and so on. So if that's right, like what would it take to reverse populism? Or do we just have to wait for the cycle?
Um, I think, like, just like Plato described it, in the Republic, in a sense. Um, you need the strong leader who can bring people together, and uh, pretty much dictate what needs to be done, even though it's difficult and unpopular. I mean, that's the classic. That's the classic. Okay, and so when you look at that, the problem is um, people have different views of what that leader looks like. But they want leaders like that, the strong leader who will get them to do it the damn right way to do it, and so on. Well, but you need one who will bring the country together and fight against the extremists, and have a path that they get people to follow.
Okay. And moving into the geopolitical side of things, which you said might serve as a shock. So when you spoke to AIC 2 years ago, you told us that 3 years out, the world would feel like we'd been through a time warp. And you described the United States as a very much of an overextended empire. We're more than halfway through that window now. And in your recent writing, you've sharpened this analogy. So, like Suez Crisis in 1956, the Dutch in the 18th century, or the Spanish in the 17th. And I'm looking at the forces that you've laid out, the five forces, and especially the geopolitical force and the global world order. What has tracked your 2024 view, and is there anything that surprised you?
Um, I think we're tracking it at never forecasts are never precise, but by and large, um, I'd be surprised if anybody said it's not tracking that. Don't the exact time or the exact way, I'm not sure of, but oh, 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 I think that like right now, what's happened, let's say in Iran with the war, is has led to a very big change in much the same as the Suez crisis was for the British Empire. In other words, what's happened is that everybody recognizes that the United States is unlikely to be able to fight a war in defense of others. Okay. Um, that it, here's this uh, here's this case in which they can't can they take control back from Iran, um, control of the Strait of Hormuz. Um, can they do these things? Can they win against what would be considered a middle power? But even more importantly, will the United States be there to defend us? The United States has bases, about 750 bases in about 80 countries. And most of those bases are there because in this world order, there's this notion that the United States would be a countervailing force, like particularly in Asia, related to China, and so on. Okay, that view is out the window now. Um, it's very clear that cost of living, things like if gas prices are too high, if the war isn't over in weeks, if if you lose anybody in the war, you can't fight the war. And so that's changed in a way that's dramatic, okay, in terms of the changing of the world order. And also, uh, look how much money China is making. Um, if you look at China Inc., in other words, China is dealing with the rest of the world, you know, their trade balances, the trade surpluses are enormous. And, at about a trillion two a year. And so they're accumulating financial assets. I was just in China. I've been going to China for 42 years, and I actually helped them build their system, their stock markets, and all that a little bit. And I have these relations, and they, the question is, what do I buy? What do I do with all this money that I'm earning? And the central bank doesn't want to buy more bonds for the U.S. and so on. So you're seeing China, uh, you're seeing a big shift in the world order. Think about the tribute system. I don't have, probably we don't have the time to explain how China thinks about such things, but things, if you want to understand it, understand what a Confucian mindset is, understand that it's an extension of family and they control their families, understand what the tribute system is, understand what the 100 years of humiliation what means to them, understand what the art of war is. If you understand those things, then you will see that China is recognizing and is um, 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 a comparable power, and that in the region, it's we're going to go back to the tribute system. Um, and so, certainly geopolitically, we have that. Politically, I think we are following the path. I think that we're going to have midterm elections. And in those midterm elections, I think probably the Republicans will lose the House, and they're going to be big fights, bigger fights. Impeachments of the president, uh, investigations of corruption because his family's been involved in things. I mean, I think the fights are going to get very worse along those lines. Certainly, the politics has changed a lot. The debt money issue is progressing as a big concern. We're seeing, you know, the changes in the markets, the yield, how the yield curve has changed, how the long rates. You see it in your markets, we see it in our markets. That we are seeing unbelievable changes in technology. In other words, yes, I would think most people would think that we are going into a time warp. In other words, I would say most everybody will say, okay, give it a couple of years, and this world is going to be a very different place.
Sure. And so we have like as you touched already, like the China topic itself and their sensitivity going back far beyond in history is quite fascinating, and hopefully we're gonna have time to discuss that another time. But like so we have the war in Ukraine, we have the crisis with Iran, and at the same time we have the United States president and like very high level delegation of like leading United States companies visiting China. And the China is this new sort of up and coming power, and the United States is a declining one. So how do you see that relationship playing out, considering how much experience you have and understanding of the Chinese people and culture going back to the time of Deng Xiaoping in the 80s?
Well, for, uh, the story begins in 1838. Okay, and just to so you get the story because it's the story that is in their minds and so on. China was on top of the world, and there's the foreign powers, particularly the British, come and the Chinese, and they want to trade. China has tea and silks and porcelain and so on. They want to trade. And China said, the Chinese emperor said, I'm sorry, we don't need anything. And basically, we don't want you as part of our lives. But there was a big difference in powers. And so they had the Opium Wars and the occupation of various parts of China by foreign powers, including Japanese taking Taiwan and so on. And that went on for 100 years, in which they view that the 100 years of humiliation. It's not like anger; it's humiliation. They hold it on themselves, but to never be in that position again. Okay, very important. Never be in that position again. And then, there's the end of World War II, 1945, and the foreign powers, the leading powers, particularly the United States and Great Britain, tell China that Japan will lose its control over Taiwan and it'll be part of China. And so everybody agreed part of China, but they had a civil war. And in that civil war, the capitalists against the communists, that's the way, left versus right. The communists win domestically, and the capitalist runs to Taiwan, takes over Taiwan, and so that was viewed as an internal affair. And so the question of who controls China was a different thing, and that evolved in terms of the United Nations and so on. And then they started China in 1949, and then they wanted to be isolated from foreign powers and so on and build it. That isolation meant that they had lack of development and they got weaker. And they were particularly worried about Russia, the Soviet Union at the time. And the Americans were worried about that, and so we had the beginning of welcoming them into the world community. Mao dies, and then in 1978, Deng Xiaoping comes to power, and he opens China, open door to modernize China and reform it. So we had really a move much more to market-based economies and so on. And that's all then evolving. That is evolving with the same Confucian um, factors that I'm mentioning before, including the tribute system. So, what I think you're going to see is a long winded answer to your question, but I wanted to convey the psychology and what's all behind it. I think what you're going to see is the tribute system by and large emerging, and that the issue of Taiwan is a very important issue. Like, it's not going to be like forgotten about or accepted. And so you'll see more of that. The pressure will be nonviolent in terms of dealing with that. There are two parties in Taiwan. And one of them is the traditional Kuomintang party and so they had the head of the Kuomintang party visit Xi, and there's kind of a peaceful reunification type of thing and so on. But the Taiwan one country is something that they would go to war with. And so it'll be an issue and it'll evolve, and it's not going to evolve forever. It'll probably be in one way or another dealt with in Xi's second term, and we'll see what the world looks like and so on. I think it would be very difficult politically for the United States to get into a war about Taiwan and so on. And the way that could happen, I mean, the way that China could play this is it could do peripheral stuff, fly more over there and so on, and things that would be provocative, and they'll find that the U.S. doesn't show up. I think that would be more likely. And then in the region, to develop more regional tribute system. And we're seeing countries in the region go up, have meetings with Xi. We're seeing European leaders, almost like a tribute system, go there and have meetings, and we're friends, let's do things together, kind of thing. And I think that that's the case. They really avoid military war almost at all cost, not at all cost, but almost at all cost, because of this whole philosophy of its Confucian, its tribute system, and so on, and the art of war. The art of war means if you can't win without having military conflict, you mustn't have been very smart. So I think it'll look like more like that.
Cool. And yes, and I must say, like, Ray gives quite a good account of the Chinese culture and their understanding in your book, Changing World Order, which we still have some copies left over from the previous time you donated to our society. So I'm sure I'm just gonna pick it up later. And I'm zooming out of China and the United States relationship and thinking about Europe. Remember, like when I was in the audience in 2024 when you spoke to my predecessor, you said Europe was in graceful decline into irrelevance. And nowadays, like Europe is more exposed to like say the higher oil prices. It has higher sort of it pays higher yields on its debt, and it just seems in a weaker position. So my question is the decline that Europe's going through still graceful?
Um, it's graceful in that by most times, Europe is a lovely place to be. You know, um, you know, you can lose wealth in that way and so on, and it's relatively graceful. Was the decline of the British Empire graceful? It had a lot of problems and so on. Um, it um, it is on the brink of being violent, but it's not violent. It's I don't know. I'll leave that to you. It's not like civil wars. It's but it but the picture that I painted, I think, is unfolding that way.
Sure. Sure. And as I promised to you at the start of the session, now we're gonna move on to the technology force and like the role of AI. And you've described previously AI as to being the early stage of a bubble, and you promised that you would share your bubble indicators. Without preempting that piece, can you tell us briefly like what distinguishes an early stage bubble from a late stage one in your framework? I know it's a quite a big question that everyone's trying to answer, but if you could briefly give us an advice on that.
Okay. Um, a lot of people make the mistake of believing that a bubble is when a company um, is in a position that their future earnings will not make the present value of um, which is the price, the present value of their stock, that because the future earnings don't justify that. And the future earnings, of course, the duration or the length of future earnings goes out a long time. The duration of the stock market is probably 20 years or more, and so on. That's not true. Um, for example, there are many stocks that crashed out of the two biggest bubbles was 29 into the 30s and particularly down to 1933, and also the 2008 and 8 tech bubble. And so you see in those cases declines of 80%, something like that, and particularly the new technologies. So a number of things happen related to that. The first is um, that there's a lot of overbuying um, by those in weekends, often um, with borrowed money um, that requires um, people to come up with cash, and that the value, the wealth that is produced becomes enormous relative to the amount of money there is. I want to distinguish wealth from money. Uh, Wealth uh, is, the stated value of what you own, and so right now you can float a company, let's say $50 million out of $1 billion valuation, and you're considered a billionaire, and it's considered worth $1 billion. Um, and so that's a lot of wealth. And in the world now, we are producing a lot of that wealth, and it's producing, by the way, very big wealth gaps and so on. When that happens and there's a need for money, um, you have to sell wealth because you can't spend wealth. You can only spend money. So that means you have to sell it. Now, for example, if there was wealth taxes, those who have a lot of wealth would have to come up with money, and that would mean they'd have to sell. And if they sell for money, and quite often when people borrow money, they have to sell to pay off their debt service, and that particularly creates bubbles, particularly if the ownership is in weak hands. So people jump on the bandwagon and they really can't afford to take the downturn. And particularly, it works with the economy in a self-reinforcing way because when that goes down, when the markets go down for those kinds of reasons, then wealth goes down and incomes go down, and then people are more inclined to sell and all of that. So, that's pretty much what a bubble looks like. And so you can follow the bubble, identify the bubble by measuring those things, particularly the cash flows.
And lastly, I'm conscious of the time as well, but lastly, like for the students who are going into this world now to work and so on to start their careers, and wondering whether AI is a tool or replacement for the work that they're currently training and studying to do. What's your honest read about that?
I've been building investments with AI, as I described earlier, um, from programming decision-making machines, expert systems, and so on, by writing down all these principles and computing them into computer code. Um, and I find it's enormously empowering. And you can, and now better than ever, you can program it to um, think and be an equal thought partner and do things. And what that means is for those who are on, the cutting edge of it, it's like a wave. If you're riding the wave and you're right on the cutting edge of that and you're using that in the best possible way, um, this is going to be fantastic. If not, the wave is going to take you under, and so that's just the way it is. And so, um, like I would say for you all, what you have to do is, you know, your early stages in your career. So for the amount of knowledge you have, it's not much, at least by the outside world's judgment. You've not been tried and true and tested and all of that. And so, like in many of those jobs, it's much easier to deal with an AI and than to deal with you at all. On the other hand, if you can get yourself into that position, I'd even say with my family office and also what I'm trying to do is AI things. If there are people in this group who are interested in, um, some sort of a relationship, a job, maybe it's something else. If maybe you can have them submit resumes and something, we could take a look. But in one way or another, you have to get there. So you've got great power. It still requires that inventiveness. Let me make this point, key point. Um, the people who are on that cutting edge are the most valuable resource, more valuable almost um, than the AI. But what's happening if you look at investment money, it's try to find those people.
Okay.
So be around those people, be part of that people. It's the 1% or the fraction of 1%. That's what you need to do.
Cool. And then last question for me before maybe we do one question from the audience. You've told the story like many times in your interviews of starting Bridgewater in 1975. Imagine you're 26 today with the same curiosity and the same nature and the same love and appetite for the markets, but you're graduating in like 2026. Where do you start?
Um, First of all, number one is play the game. Get out of theory, play the game. Okay. Then be open minded of how you're going to learn the best. Um, know your nature and find the path that's suitable for your nature. There are different people who think different ways. So, and then be around the smartest people you can be around. Be in an environment. You picked an environment when you chose the school you went to. Okay. I think you know this. Just keep elevating yourself around that. And then the most powerful thing to realize that's not intuitive, I mean, a couple of things, is knowing how you deal with what you don't know is more important than anything you know. Okay, so how do you learn and accelerate that? And then the second is, yeah, pain plus reflection equals progress. In other words, experiment, be there, and make the most out of your painful experiences to learn.
Cool. Thank you. And now one question for that was like pre-submitted by the attendees. So like this question asks, the current period has been described as a once in 80 years inflection comparable to 1971 and the late 1930s. With that, internal politics, world order, nature, and technology all shifting at once. For investors deploying capital over the next 30 years, what does it actually mean to invest through a regime change rather than a short cycle?
Um, to that if you look back on them and you think of all the risks, above all else, it's not just the returns, it is the taxation, it is the wealth confiscation, it is financial repression. There are these risks, and they will vary by country and by location. And so there's, wealth preservation, if you're thinking about like, okay, how do you play that game? Also you have to think globally. One of the interesting things, like I mentioned, is that 85% of the populations, countries since 1900, if you look at what we call countries, there would be the borders changed. But let's say, using today's definition of countries, about 195 countries, 85% of those countries were places you had to flee from. That different people flee or from other places and so on. I'm creating a game, which is you start. I don't know if you know the game Risk. The game Risk. You go on it, and there's all these countries, and you land on. I'm going to start it with in 1900 with $1 million. You're given $1 million in 1900, and now you have to decide where you're going to be and what you're going to do, and so on. And you see whether you can survive from 1900 to now, and how you can do. Okay, that's okay. So, anyway, what I would say is that you have to understand these things. Play that game. Get out there, play that game.
Okay, perfect. Well, thank you very much, Ray. And also thank you very much for donating your new book, How Countries Go Broke to Our Society. We've given out to like the in-person attendees now, and we'll be giving more out throughout the campus over the next few days. So thank you very much. And hopefully, before I finish, hopefully we're gonna have another follow-up session of you with AIC with my successor, and hopefully maybe in person on one of our flagship conferences. So thank you very much, Ray, for your time, and we sincerely appreciate your insights.